Hi, I'm Rob. Today we're going to be going over the difference between accumulating and distributing ETFs and explaining the pros and cons of each. Briefly, an ETF is an exchange-traded fund and can most easily be understood as buying a basket or a bundle of stocks as one holdings. Most ETFs are known as passive investments and track an index, but some are actively managed and the managers of the funds pick stocks for the holders of the fund. The main indexes that these ETF follows are the S&P 500, the Dow Jones Industrial Average, the Nasdaq 100, and the FTSE 100, 250, and 350. There are two main types of ETFs. First is distributing. As mentioned, ETFs hold shares in multiple companies, sometimes in the thousands. Some of these companies will pay out dividends to their shareholders. Around 400 of the 500 companies in the S&P 500 pay dividends. However, you aren't a direct shareholder in each company, so what happens to the dividend payments? This brings us to the first type of ETF, which is the distributing ETF. Now, the ETF doesn't relay every dividend payment onto you, as this would be far too much work and the amount you owned for most companies wouldn't be more than a penny. Instead, what they do is collect the dividends for you and distribute them to you, usually on a quarterly basis. As individuals companies paying dividends, the ETF's share price will drop on the X date. As explained in one of my previous videos called What are dividends and how do they work? You don't lose any value or return, as you will get the dividend paid to you on the pay date, even if you sell. You can usually see the X dates on the distributing graphs. Here's VUKE, a FTSE 100 distributing ETF. On the 18th of March, this ETF had an ex-dividend date for 0.464, worth around 1.55% of the share price at the time. On the 17th of June was 0.305, worth around 0.97%. And the 16th of September was 0.464, worth 1.51%. Let's look at a Vanguard S&P 500 ETF, VUSD. Over the past year, it has increased 29.6%. This is not including dividends. Its share price is up 101% in the past 5 years and has paid out $4.58 per share over the past 5 years, adding roughly another 11% to the total return. Next is another Vanguard ETF, but this one tracks the FTSE 250. VMID share price is up 25% over the past 5 years, with it only really turning positive thanks to the past year where it has gone up 32.7%. But it has paid out 390p of dividends in the past 5 years, adding around 13% to its total return. The UK market had performed poorly over the past few years due to Brexit and the pandemic. Now, with accumulating ETFs, you don't receive any dividends payments. Instead, they are reinvested back into the ETF. This increases the ETF net asset value, and therefore the share price will rise the same amount as a dividend reinvestment. And there won't be sudden share price drops on the distributing equivalent X date. Here's the accumulating equivalent of VUSD. VUAA has increased 31.1% in the past year, with obviously no dividend payments. And the accumulating equivalent for VMID is VMIG, which has increased 36.1% in the past year. Now, what are the pros and cons of each? Is one going to make you more money? The short answer is no, but they do have their slight advantages over each other, depending on your personal circumstance. Firstly, is dividend payments from distributing ETFs can be withdrawn and used as a source of passive income. However, this is more aimed at large holdings, as personally I don't see much point in withdrawing small dividend payments, but could vary on personal circumstance. Next is what many see as the main advantage of distributing ETFs. It gives you the option to use dividends to reinvest into other ETFs or other companies. Personally, I take dividend payments and then reinvest in my holdings that are underperforming or have had a recent share price drop. I often see lots of investors getting fixated on reinvesting dividends back into the same company or ETF. Like Apple dividends have to be used to buy more Apple shares, which causes them to treat cash from dividends different to their own cash, which fundamentally makes no sense. Distributing ETFs involve a little bit of extra management, unless you want to have the cash sitting in your investment account. Dividends are also often taxed, unless in a tax-free account like an ISA. That's not to say that accumulating ETFs are never taxed. You still pay capital gains tax. However, the tax-free allowance is higher for capital gains than is for dividends. So therefore, manually selling and accumulating ETF for roughly the same amount as the dividend payment of the distributing ETF would save you on tax. Lastly, on taxes. Some international ETFs will charge a withholding tax fee, usually of around 15 to 30% of the dividend. This is quite a large amount of the dividend being taken away, even before you pay any potential domestic taxes. Also, some dividend payments might be too small to reinvest. If you have a small holding with a low yield, or that your investing platform set minimum trade amounts, you might not be able to reinvest the dividend payment. Now, accumulating ETFs can save you money on fees if your trading platform charges trading fees. This can also include foreign exchange fees if the ETF isn't a local currency. Foreign exchange fees could also be applied twice, once you convert the dividend back into your local currency and then back if you choose to reinvest into the same foreign ETF. For anyone using Trading 212, this would cost 0.15% twice. With accumulating ETFs, you can put a pot of money into one ETF and just leave it. There's no real management required. Lastly, the dividend payment which are automatically reinvested for you could be done at all-time highs. Now this isn't always a negative. Most of the time investing at all-time highs is better than waiting for a drop. However, you might not want to reinvest at a sudden share price jump. So those are the two types of ETFs. Which of them do I actually own? Well, the vast majority of what I own are accumulating. I own CNX1, which is Nasdaq 100, VMIG as mentioned earlier, and a small amount in IITU, a S&P 500 ETF, which is focused on IT companies. And I also own an all-world accumulating ETF. One distributing ETF I own is the iShares Global Clean Energy. This is because I'm not sure there is an accumulating version, or at least not on the Trading 212, the platform I mainly use. So thanks for watching. Please like the video if you enjoyed, and also let me know which type of ETF you prefer in the comments.